Okay, so we left off on the previous slide. So we'll look at definitions. We've already spoken about the taxable temporary difference and the deductible temporary difference. But just as a reminder, we'll have a taxable temporary difference when our carrying amount is more than our tax base. And then we'll have a deductible temporary difference when our tax base is more than our carrying amount. Alright, so we'll speak about the tax base of an asset and tax base of a liability as we go along and as we continue with some examples. Okay, so I found our class examples. So we'll start off with income received in advance. So income received in advance, right? We will be calculating a deferred tax adjustments, right, and our balances related to our income received in advance. So again, we'll be looking at the carrying amount of the liability, and then we're looking at the tax base, right? So the carrying amount minus tax base will give us a temporary difference, and we'll calculate our deferred tax balance based on the the temporary difference. And remember, we calculate our adjustment by deducting the closing balance of the deferred tax asset minus the opening balance of the deferred tax asset, right? So, the carrying amount of the liability, I mean, from an accounting perspective, that's easy, right? So I'm not going to go over that. It's whatever we have received. So it is whatever we have received and not yet earned, right? Because remember, income received in advance it's recorded as a liability because we've received income but we've not yet earned income. Right, so the carrying amount is easy. So what we're going to be focusing on is going to be the tax base, right? So how do we determine the tax bases of income received in advance, prepaid expenses, accrued expenses, provisions, and then income receivable, right? So so that's what we'll be focusing on. So for income received in advance, right, our tax base. So, income received in advance, our tax base will be equal to the carrying amount less the portion that won't be taxable in future. So, the portion that won't be taxable in future, I mean, that's a mouthful, right? So, just look at what accounting does and what SARS does, right? So, from a accounting perspective, when we receive the income in year 1, we record a liability, right? And in the next year, when we earn the income, so let's say year 2, so year 1 we receive the income, year 2 we earn the income, right? So in year 1, from accounting perspective, when we receive the income, we record it as a liability, and in year 2, when we earn the income, we then record it as when we've earned the income, we then record it as income. From a tax perspective, it's the earlier of receipt or accrual, right? So from a tax perspective, in year 1, when the money is received, they tax the income, right? So if we look at the tax base, right? So the tax base of income received in advance is the carrying amount, right, less the portion that won't be taxable in future. So what won't be taxable in future? The amount that we have received, right? Because why won't it be taxed in future? Because it was taxed in year 1. So it will not be taxed in future because it's already been taxed in the current year. Right? So income received in advance, SARS taxes the income when it is received. So in future, the amount that won't be taxable is the amount that we received as income received in advance, right? Or that we received and then recorded as income received in advance. Thus, the tax base is 0. Why is tax base 0? Because the tax base is calculated by saying the carrying amount. So let's say, for instance, we received 100 Rand, right? So our carrying amount of our income received in advance is 100, right? Less the portion that won't be taxable in future. Remember, the 100 Rand, from a tax perspective, the 100 Rand is taxed in the current year that we receive it. So in future, it won't be taxed again, right? So what won't be taxed in the future? The 100 Rand. So our carrying amount, which is 100, minus what won't be taxed in future is 100. So our tax base is 0. So, oh, okay, I wrote a little example over here. So if the carrying amount of income received in advance is 100 and the amount that won't be taxed is 100, because remember the 100 will be taxed in the current year, it means then that the tax base is 0. So let's look at an example quickly. ABC Limited received rent income in advance, and that amounted to 10,000 Rand. The income was received in 2018 and will be earned in 2019. So from an accounting perspective, 2018 we record the income received in advance. In 2019 we record the income. From a tax perspective, in 2018, alright, we tax the income received, right? The income received in advance from an accounting perspective. But so in 2018, the income is taxed, right? And so the company has no other income. So calculate the deferred tax adjustment using the balance sheet approach for both years. So at the beginning of 2018, we had nothing, right? And then the closing balance of our we have a liability. So we put it in brackets over here. 10,000. Remember, our tax base is 0. Our tax base is 0 because it is the carrying tax base is calculated by saying the carrying amount minus the amount that won't be taxable in future. So it's the 10,000 minus 10,000 will give us 0. Our temporary difference over here is 10,000, and then temporary difference times 28% will give us our deferred tax. Right, will give us a deferred tax balance of 2,800. And there I've written over there that we have a deferred tax asset. So why do we have a deferred tax asset? SARS taxed this income in the current year. So the future income, so the income that we're going to record in 2019 will not be taxed, right? 2019 won't be taxed on the income that we record. So essentially we're having a future tax saving or a deductible temporary difference, right? So in 2018, the adjustment that we're going to process, so remember we calculate our deferred tax adjustment, the closing balance minus the opening balance. So our deferred tax adjustment is 2,800, and the journal we will process is debit deferred tax, credit tax expense. Then for 2019, our liability, we've earned the income, so we would have extinguished the liability over there. We don't have a tax base, no temporary difference, and so our deferred tax asset, or we do not have a balance for deferred tax over there. So remember, deferred tax adjustment is the difference between the closing and the opening balance. So now we have to decrease our deferred tax asset, and then we have to increase our tax expense. Whoops. Then our current tax calculation. So I mean, we've covered this when we did chapter 5. We add our the closing balance of our income received in advance for 2018. So then our current tax is 2,800. Our taxable profit is 10,000. Current tax is 2,800. Our accounting profit. So remember, accounting profit, we've earned the income received in advance in 2019. So we have our accounting profit there of 10,000. We make our adjustments for our temporary differences. No closing balance, but we do have an opening balance, and we deduct the opening balance over there. So our taxable profit is 0. No current tax. So here we go. So in our statement of comprehensive income over here, we have no for 2018 we have no accounting profit. 2019 we have accounting profit. For 2018 we don't have any income tax. I'll show you. We'll speak about that a little bit later. For 2018 we have our income tax of 2,800. So for our income tax, so remember, for our current tax is 2,800. Right, for 2018, our deferred tax adjustment, we have to credit our tax expense. So crediting tax expense meaning that we are decreasing our tax expense. And so obviously our income tax is 0 because we didn't have any income, right? And then our current tax for 2019 is 0. our deferred tax adjustment that we made was 2,800, right? We increase our tax expense over there. So our tax expense is 2,800, and there we have our deferred, our total tax expense 2,800. And then in our financial statements, we would then show our non-current asset, deferred tax asset 2,800, and in 2019 we wouldn't have anything. Alright, so I will continue in the next video.